The challenge is that as you accumulate capital, two things change. One is you have more capital at risk, and two, as you approach retirement, your investment horizon starts to shorten. So that's where objective-based investing comes in, and the genesis around objective-based investing in Australia has really come about post the financial crisis. Of people thought about, how do I try and tackle some of these issues, such as drawdowns of 30 or 40% in equities. One of the things I do enjoy when having a conversation with a client, and this could be from an advisor through to a pension fund or a charity, is when they actually explain to me their objectives, they're often defined by two things. One, I have a return objective over a certain horizon, and two, I have a risk that's either a volatility number or some form of a 1-year loss every 5 years. Now, as we have this conversation, I tend to dig a little bit deeper and find out really is what they're trying to solve for. A good example is if they give me an inflation relative objective of, say, CPI plus 4 or 5%, then we tend to have an allocation that sort of has 70 or 80% equities. As we go through that process, I explain to them that then they're probably likely to have a potential 1-year shortfall of 20 or 30%. Are they comfortable with that? And the answer is no. They want to have a shortfall that's closer to 10% or 5%. And so then the allocation might be more appropriate to be 70 or 80% inflation-linked bonds. But that process is really important to really try and uncover the hidden objectives that aren't always stated in those two dimensions. And we've developed what we call a weighted risk metric, which helps think through those objectives and actually apply a weight to them to actually understand what it is they're trying to achieve. One of the things we try to uncover through that is explaining to our clients that you can have anything you want, but you can't have everything you want, and you need to make a choice. And the reason why that's important is if we are going to deliver on objective-based investing as a distinct characteristic that's different from strategic asset allocation portfolios, we really need to deliver on that objective. So the clearer you are on that objective, the more likely you are that you're going to understand what we're doing in the portfolio, particularly through market cycles and when there's large dislocations. And that keeps you on for the long-term strategy. And that's really important because people that have invested in SAA, particularly through the financial crisis, often quite naturally felt the risk and it was too much for them at that particular point. So they actually pulled out at perhaps the very worst time. Whereas if we actually keep them invested through the long term to that objective, we can keep them along their strategy towards their end goals. I've talked very much to what my own heart, which is about multi-asset investing. As a multi-asset investor, you are being diversified. In 2006, when I first started in this industry, you had to hold someone by the arm to talk about diversification. Markets were rallying hard, and people didn't really care about diversification. There's some similarities now in terms of people have made a lot of money over the last 10 years by just being long risk. And we talked about the potential for, are we in a late cycle? What are some of the ramifications of the trade wars that are being discussed right now? With diversification, with multi-asset investing, you are almost always preparing for some sort of correction. And so you're not sort of trying to time this, you're just trying to take advantage of the current balance of risk and reward to shape your portfolio for those outcomes. Another thing that I think about when it comes to potential doomsdays or corrections that's very different to say 10 years ago is you can use things like option strategies. That could be explicit put protection on your equity portfolio. It could be going long volatility through things like the VIX futures. But these are forms of insurance and they can be used. They're expensive and the price of that insurance is quite dynamic as well. So the way in which I would suggest using those sorts of things is very much around specific event risk. Things like a US election result or a Brexit referendum, they can be useful to provide you a cushion through an event. But any longer than that, you really need to have a conversation around, am I comfortable holding the risk that I'm holding in the overall portfolio?